Imagine a profession where up to, well, 95% of the absolute smartest, most ambitious people on Earth just fail entirely within their first year.
Yeah, it's brutal.
Right. Welcome to proprietary trading. It's kind of a classic human story, honestly. Someone packs up their guitar, buys a one-way bus ticket to Hollywood, and they step off onto the Sunset Strip, absolutely convinced they are going to be a rock star.
Oh, yeah, the classic delusion.
Exactly. They look at the massive billboards, the sold-out stadiums, and they think, yeah, that's my destiny. But what they don't look at are the thousands of equally talented people serving coffee, playing empty dive bars, and, eventually moving back home.
Because that part isn't glamorous.
Right. So today we are looking at the financial equivalent of that Hollywood dream, where a firm gives you their capital to trade with, and you get to keep a cut of the profits. It's really great to have you here for this deep dive.
Thanks for having me. And, the allure of that specific model is just incredibly powerful. I mean, you see the outliers on social media, right? The people making seemingly impossible amounts of money from a laptop on a beach.
Oh, always on a beach.
Always. And your brain naturally assumes that is the baseline reality. But the failure rates in prop trading offer this massive magnifying glass on human behavior under pressure.
Which is exactly why we're here. Our mission today isn't just to talk about, financial markets. We are extracting a survival guide from this really eye-opening piece of source material called The 5 Pillars of Proprietary Trading Failure.
It's a fantastic read.
It really is. We're going to reverse engineer why highly intelligent people basically self-destruct in extreme environments and use that to build a framework for you to navigate the steep learning curves of literally any complex high-pressure field.
Because the timeline required here is just staggering.
Yeah, listen to this timeline. Most successful prop traders report that it takes 1 to 2 years of consistent effort to achieve reliable profitability. Beginners need to plan for at least 6 to 12 months of just surviving before seeing consistent income.
Just surviving. Not getting rich, just staying alive.
Right. Okay, let's unpack this. Because you obviously can't reach that 1 to 2 year milestone of profitability if you blow up your trading account in month 1.
No, you definitely cannot. I mean, you can't master a skill if you don't survive the learning phase.
Yeah.
Right. And that brings us to the first massive obstacle traders face, which is this collision of poor risk management and insufficient capital.
The math of survival.
Exactly. The math of survival in trading is fundamentally unforgiving.
Well, let me push back on this for a second, or at least, play devil's advocate for the ambitious beginner listening to this.
Sure, go for it.
If the whole point of moving to Hollywood and getting funded by a prop firm is to make significant money, the golden rule of risk management we found in our sources seems, completely counterintuitive.
How so?
Well, the recommended approach is to never risk more than 1% of your account on a single trade. So if I have a $10,000 account, I'm risking $100. That sounds incredibly slow, totally boring, and it'll take an absolute eternity to build wealth.
I get that a lot. But good trading, at its core, is actually supposed to be exceedingly boring.
Boring is good.
Boring is great. If we connect this to the bigger picture, the goal of risk management isn't just to accumulate wealth slowly. It's to protect you from the underlying mathematics of drawdowns.
Okay, break that down for me.
So if you take a few wild high-risk trades and you lose 50% of your account, you do not need a 50% gain to get back to even.
Wait, really?
No, you need a 100% gain.
Oh, wow.
Yeah, you have to literally double the money you have left just to get back to the starting line. But by limiting risk to 1%, you build this impenetrable shield around your capital.
So you can afford to be wrong.
Exactly. A trader could theoretically lose 20 times in a row and still have the vast majority of their capital intact to fight another day.
So it's not about making $1 million on day 1. It's about making sure you are still solvent and standing in the arena on day 300.
Precisely. And that underlying math is what rookies completely ignore. They overexpose themselves to single positions, basically putting all their eggs in one basket.
Right.
And they fail to use a stop loss, which is just, a basic automatic circuit breaker that caps a losing trade.
So instead of taking a tiny paper cut, they just bleed out.
Yeah, they watch a loss grow while just praying it'll bounce back. And they also fundamentally misunderstand risk-to-reward ratios.
Oh, explain how that ratio plays into the 1% rule, because that's crucial.
So if you risk 1% of your account, say $100, your target profit on that specific setup should be $200 or $300.
Okay.
When you enforce a 1 to 3 risk-to-reward ratio, you only need to be right 25 or 30% of the time to remain profitable.
Wait, let me make sure I'm hearing that right. You can literally be wrong more often than you are right, and your account still grows.
You can be wrong 70% of the time.
Hmm.
But beginners, they'll routinely risk $300 to make $50.
Oh, yikes.
Yeah. Which means a single loss just wipes out a whole week of small wins.
That makes perfect sense mathematically. But there is a real-world component tying into the survival phase too, right? The source talks heavily about the timeline of the learning curve and the absolute necessity of having adequate capital for your actual life, not just your trading account.
Oh, absolutely. And this applies to starting a business, freelance writing, really any entrepreneurial leap. Beginners have to maintain entirely separate savings for living expenses during that 6 to 12-month learning curve.
Because if you don't,
If you need your trading profits to pay your mortgage or buy groceries this Friday, you are going to force trades that simply are not there in the market.
you're trading out of need, not opportunity.
Exactly. Financial desperation triggers cortisol, it completely clouds your judgment, and it just destroys discipline.
Right. You are trying to extract money from the market because you need to pay a utility bill, not because the market is actually offering a high probability setup.
Exactly.
So let's assume the shield is in place. We kept our living expenses separate. We are strictly obeying the 1% rule. We are surviving.
Good. Step one complete.
But standing in the boxing ring without getting knocked out doesn't mean you are actually winning the fight. To generate profits, we have to move from defense to offense. We need a verifiable reason to enter a trade.
Right, we transition here from the casino mentality to the blueprint mentality.
Mm-hmm.
The source points out that most beginners trade based on feelings or maybe random technical indicators they barely understand or just unverified tips they read online.
It's like going to a doctor with some vague symptoms,
Yeah.
right? And the doctor squints at you and says, my gut is just screaming that it's this rare disease. I have a really strong feeling about it. Let's do surgery.
You would sprint out of that building.
Yeah, exactly. You want blood tests, x-rays, lab results. You want hard data. Yet in trading, people act like their gut-feeling doctor all the time.
All the time.
But here is my question. The stock market is essentially millions of human beings and algorithmic computers buying and selling in this massive, chaotic tug of war. How can you have a scientific blueprint for chaos? Like, what makes a strategy genuinely proven?
What's fascinating here is that you aren't actually trying to predict the chaos. You are trying to extract a statistical edge from within it.
Okay, how?
Think of a casino running a roulette table. The casino does not know, and frankly does not care, if the next individual spin of the wheel will be red or black.
Right, they don't sweat individual spins.
Exactly. They just know the mathematics of the wheel are tilted slightly in their favor over, say, 10,000 spins. Finding a proven trading strategy requires that exact same scientific rigor through a process called backtesting.
Walk us through what backtesting actually looks like in practice. How does a trader literally do that?
Well, it is entirely data-driven. A trader defines a rigid set of rules for entry, exit, and risk management. Then, they take that framework and apply it to years of historical market data.
So they're looking backward to see if it would have worked.
Yeah. They might write a script or manually comb through charts in the past 5 years to see how that specific pattern performed. Did it make money during the 2020 crash?
Right.
Did it make money during the 2021 bull run? Once they have a massive sample size proving a positive expectancy, then they move to forward testing.
Like a pilot putting in hours on a flight simulator before they ever step foot in a commercial jet.
That's a perfect analogy. They trade the strategy in real time with fake money in a demo account. Because the psychological pressure of a live market, even with fake money, tests whether the trader can actually execute their rules without the benefit of historical hindsight.
Oh, that makes sense. Because winning 5 trades in a row could just be luck.
It's just statistical noise. Executing 500 trades with a consistent edge, that is a blueprint.
Let me pause you there, because the source material brings up some deeply technical terms regarding what traders need to study to find these edges.
Oh, the jargon.
Yeah, the jargon. It mentions they must understand market microstructure, order flow, liquidity dynamics, and fundamental drivers. That sounds like a wall of Wall Street gibberish. Let's break that down. What does order flow or liquidity actually mean to a normal prop trader sitting at their laptop?
Okay, think of liquidity as the depth of a swimming pool.
Okay.
If a market is highly liquid, like major currency pairs or large-cap tech stocks, it's a very deep pool.
Mm.
You can jump in, you can buy or sell large amounts without splashing all the water out or moving the price drastically.
And an illiquid market.
An illiquid market is a puddle A large order will violently swing the
I
price.
see, an order flow.
Order flow is the act of looking beneath the surface of the standard price chart. Traders use specialized software to watch the actual volume of buy and sell limit orders waiting at different price levels.
Oh, wow. So instead of just looking at a squiggly line going up and down,
They're seeing the raw institutional supply and demand hitting the market in real time.
they are looking at the actual engine of the market.
Exactly. And understanding these mechanics is crucial because markets constantly evolve. This ties directly into the necessity of continuous education.
Because the market isn't static.
Right. A strategy that worked flawlessly in a low interest rate booming environment might rely on momentum that simply vanishes when the economy shifts into a volatile recessionary phase.
Yeah.
Traders who stop learning just get slaughtered when the macroeconomic environment changes.
Man, here's where it gets really interesting, though. We have just built this perfectly logical, rational machine. We have the bankroll, we cordoned off our living expenses, we are adhering to the 1% risk rule, and we have a strategy mathematically back-tested over 1,000 trades.
Sounds bulletproof.
On paper, we are completely insulated from failure, but none of that matters if the human brain hijacks the steering wheel.
Oh yeah. Human nature is the single greatest point of failure in literally any high-stakes system.
It's the ultimate boss battle.
It really is. You can have a flawlessly coded strategy, but the moment a human being with a pulse and an ego has to actually execute it, the probability of self-destruction skyrockets.
I want to use an analogy for this biological mismatch because it's so fascinating. Imagine driving on a highway in the winter and you suddenly hit a patch of black ice.
Terrifying.
Right. The biological, intuitive human instinct is to slam on the brakes and jerk the steering wheel away from the slide. But if you do that, you spin out and crash.
You're done.
The trained, completely counterintuitive mechanism to survive is to take your foot off the brake and steer into the skid. Trading feels like a constant state of hitting black ice. Can a perfectly back-tested strategy really be destroyed just because a trader gets a little frustrated?
Incinerated is a much better word than destroyed.
Really?
Yeah. Trading requires actions that run contrary to hundreds of thousands of years of human biological wiring.
Mhm.
We are evolutionarily programmed to avoid pain and seek immediate reward.
No.
So when a trader enters a position and the market immediately moves against them, the brain does not process that as a mathematical probability. It interprets the loss of resources as literal physical pain. It perceives a real threat to survival.
So the rational part of the brain, the prefrontal cortex where all that back-testing lives, it just powers down.
Completely shuts off. The amygdala takes over, the fight or flight response activates. You are no longer a disciplined professional executing a statistical model. You are literally a caveman running from a predator.
Wow.
And this biological hijack leads directly to the specific psychological pitfalls outlined in our source. The first one is FOMO, the fear of missing out.
Oh, yeah. You see a stock rocketing upward. Your back-tested rules clearly state it is overextended and it's too late to buy.
But your brain doesn't care.
Right. The primitive brain screams that everyone else is gathering resources and you are being left behind to starve. So you buy at the absolute peak, right before the inevitable pullback.
And that impulsive entry almost always results in a painful loss, which then leads to the absolute most destructive behavioral loop in trading. Revenge trading.
Revenge trade.
Yeah, the trader's ego is bruised. Instead of accepting the outcome, walking away and waiting for the next statistically valid setup, they feel this overwhelming urge to jump right back in to win the money back.
They want to get even.
Exactly. So they double their position size. They throw that boring 1% risk rule right in the trash.
They are basically trying to punish the market to make themselves whole. But the market doesn't even know they exist.
The market doesn't care at all. Revenge trading is the mechanism by which a tightly controlled 1% loss snowballs into a completely blown account in a single afternoon.
It's terrifying.
And the source also highlights the opposite reaction, which is analysis paralysis.
Oh, where you freeze.
Yeah, a trader takes a few normal losses and becomes so traumatized by the pain that when a perfect high-probability setup actually appears, they physically cannot click the mouse to execute the trade.
They just stare at the screen.
Or, on the flip side, they experience overconfidence after a lucky winning streak. They start to believe they have somehow outsmarted the chaos, and they start bending their risk parameters, and the market humbles them instantly.
It just sounds emotionally exhausting. You are basically fighting the market and your own DNA at the exact same time. How do the 5 to 10% who actually make it to profitability overcome their own biology?
This raises a really important question about the nature of mastery itself. The crucial skill that separates the professionals from the gamblers is reframing.
Reframing the pain.
Yeah. Successful traders learn the deeply unnatural skill of treating financial losses merely as normal business overhead.
Hmm. Thinking about losing money as a business expense completely shifts the burden. It actually makes me think of a restaurant owner buying fresh produce.
Okay, how so?
Well, if you own a restaurant and a crate of tomatoes goes bad before you can serve them, you don't fall to the kitchen floor weeping.
Right.
You don't get angry at the supplier and buy 10 times as many tomatoes the next day out of revenge. It is just a known cost of doing business.
That is exactly it. The profit from the meals you successfully sell covers the cost of the spoiled inventory. In trading, your winning trades are the meals you sell. Your losing trades are simply the spoiled tomatoes.
I love that.
They are not personal failures, they are not reflections of your intelligence, and they are definitely not threats to your survival. They are just the overhead cost required to find the winning setups.
So if you can truly internalize that a loss is just a statistical inventory cost, the emotion just drains right out of it. You stop steering away from the skid, you just execute the plan.
Yes, but achieving that state of emotional detachment takes significant time. That is the core reason the timeline for success is 1 to 2 years.
Yeah.
You aren't just learning to read order flow or calculate risk to reward. You are physically rewiring your brain's neurological response to financial pain.
So what does this all mean for us? We started by talking about those ambitious people moving to Hollywood, looking for the quick path to wealth and freedom. What we found is that the 5 to 10% who actually survive that crucible are not relying on magic, and they are certainly not relying on luck.
No, not at all.
They are relying on deeply unsexy, highly disciplined systems. Even if you never buy a single stock or trade a single currency pair in your life, the pillars we unpack today offer a masterclass in systems thinking.
Absolutely.
If you are navigating a difficult career pivot, building a business, or learning a complex new skill, the framework is exactly the same. You have to aggressively protect your downside and ensure you have the runway to survive the learning curve.
You have to survive month 1.
Right. You must rely on data-driven, back-tested strategies rather than relying on your gut. You have to commit to continuous education because your environment will inevitably change. And most importantly, you have to master your own psychology.
That's the hardest part.
Learning to regulate your nervous system, ignore the noise of FOMO, and treat your failures as simple inventory costs rather than personal catastrophes. True mastery in any domain takes disciplined, boring consistency.
It really is the ultimate reality check for raw ambition. Before we wrap up, I want to leave you with a final thought to ponder that expands on this whole idea of human frailty.
Ooh, okay. Let's hear it.
So we established that the vast majority of human traders fail largely due to psychological pitfalls, right? Emotional revenge trading, panic, and the biological inability to execute a rigid risk management plan. Our own neurology basically works against us in these environments.
Right, the amygdala hijack.
Exactly. But as we look at the modern financial landscape, human traders are increasingly forced to compete against algorithmic trading bots and high-frequency AI.
Oh, wow.
A bot does not feel fear. It does not experience the pain of FOMO. It never, ever revenge trades after a drawdown.
Right.
And it executes risk management flawlessly to the exact decimal point millions of times a day.
It doesn't have a biological response to black ice.
It just steers into this skid mathematically. So as complex systems become increasingly automated, we really have to ask, will the human element, our intuition, our adaptability, but also our emotional baggage, remain an irreplaceable asset? Or is it destined to become the ultimate liability?
Man, that is a deeply provocative question to leave on. The emotional human versus the flawless machine. Thank you so much for joining us for this deep dive.
It was my pleasure.
And to you listening, whether you are analyzing the markets, building your career, or just trying to navigate a high-pressure environment, remember to protect your downside, rely on the data, and steer into the skid. We will see you next time.